What's going on, everybody? Coming at you with episode 2 of the Real Estate Truth Show. Um, this episode is going to be tailored just for first-time home buyers. So we kind of realized with the last one, we need to take a little bit of a step back and really kind of explain the process, everything that goes into it. Some first-time home buyer tips, everything like that. So if you're a first-time home buyer looking at buying a home or just want more info, I really recommend listening in on this episode. Um, and maybe even if you're a second or third time home buyer, you're going to learn something and gain knowledge and value from it. And so, again, we're bringing on mortgage veteran Aaron Taravella, has been in the business for over 15 plus years. So he really goes in depth and detail a lot of what a first time home buyer should do to prepare and just how the process goes. So if you guys like the episode or you gain knowledge or value from it, I'd appreciate if you share with a friend, subscribe, and give it a like, and we'll have a lot more to come. So let's get into it. All right, you ready to start this thing? Round 2?
Round 2.
Yep.
Yes.
Yep, let's get into it. So here we're coming on the second episode, you guys. This one is going to be focused on just first-time home buyers. I think we kind of realized from the last one, make it a little bit more specific, especially for the first-time home buyers don't really know what's going on.
Yeah, and that's a big market, for us over here especially. So, we definitely want to make sure that we can kind of put some of the good information out there for someone that's interested in buying their first house, or, maybe if it's been a while since they've purchased, and this could be a second purchase for them, because so many things just change.
Yeah.
In this process of mortgage lending. So yeah, excited to kind of go through this.
Yeah, me too. Because I'm going to keep on saying it. Like, just with social media and everything online, like you have half the people saying it's easy to buy a home, half the people saying it's the worst. So it's just a bunch of different information. I think it's, like I've always said, it's good to learn from people in the actual business.
Yeah, and that's that is the unfortunate thing about our industry right now as a whole is it is a little scary, right? We've jumped from the 2% interest rates to sixes and sevens, and that just puts a lot of fear in someone trying to buy a house. But at the end of the day, we can't control the housing market, right? So the interest rates are going to be what they are, and it comes down to the person, or buyer. Is this the right time? What plays into those factors of what is the best time for someone to purchase a home, right? Should you wait? And what does that look like? Because no one is really going to give you a clear answer to the best time.
Yeah.
Because we could say, maybe we're waiting for interest rates to drop, but we don't know exactly when and what they will drop to.
Yeah.
So if you're just on the back burner waiting for something like that, you may not buy, or you may lose a house that, yes, you can afford, and maybe we have other options to help offset maybe the payments and interest rates on a temporary basis as well to make it a little bit more affordable. So there's just a lot of good opportunities out there. And I think just the best way to approach it, if you're thinking about buying, is just to talk to a loan officer and a real estate agent and, get some exact details on what that looks like.
Yeah, I agree. And it's free, no obligation. So it's really just kind of your choice at the end of the day. You can get, the exact information. If anything, really just kind of form a game plan for when you are ready.
Yeah, getting accurate numbers and talking to someone who knows the business and the industry, we're looking out for that person's best interest at the end of the day, and we want to help and educate that person to making a right decision. And if it's not the right time, it's just not the right time.
Yeah.
And that's not our job to push someone to purchase a home. That it has to be in that person's mindset that it's the right time to go ahead and buy something, spending $200,000, $300,000, $400,000 on a property. That's a lot of money, right?
Yeah.
So, and it's a big commitment for someone to do that. But I think as long as the buyer is educated, knowing exactly what they're getting into, looking at all the different programs available, then that person and their family has to make the right decision.
Yeah, I agree, and we'll get into a little bit of this later. But like really, like the loan officer's job is just to guide and educate. Because at the end of the day, we're not the ones that are gonna choose if you can actually go ahead and get approved for that house like the underwriters do. So really, it's kind of we're in the middle of the process, making sure that when you get to that point, it's gonna go through.
That's right. A loan officer's job is to look at all of the documentation up front. Collecting pay stubs, W-2 forms, tax returns, whatever that may be per client, and everyone's different. I may not need tax returns on, a specific buyer. I may need it on someone who's self-employed, right? Or we may be looking at a bank statement program, which you don't need tax returns. So there's a lot of different ways to structure a loan, number one. But number two is, again, going back into finding out that buyer's needs and goals. And then it's our job to say, hey, these are all the different programs that's available, whether it's a grant assistance for a first-time home buyer, whether it's a small down payment, or I have a lot of first-time home buyers that, hey, I have 10, 15, 20% I want to put down. And then at that point, we work the files up based on that. So it's just about showing what's out there, what's available for those clients, and making sure everything's affordable in this market.
Yeah, I agree, and we're gonna get into some of those details, for sure. So I think let's kind of start with, I guess, the basic question of who is even considered a first-time home buyer. Is it only people that your very first time ever in your life buying, or what is kind of the requirements?
Yeah, so that's a good question, and I actually get that a lot. So the real technical answer to that is if you have not been on a title of a mortgage in 3 years, right? So that is considered a first-time home buyer. Now, I just came across a case to where I have a client that actually inherited a home, from a father who is now deceased. She does not live in that property. It's vacant, and she plans to sell it. And I'm actually able to help her still as a first-time home buyer, even though she's actually owns the house now. But since it's an inherited property and some other factors that take place, I can still consider her a first-time home buyer. So,
oh, wow, that's interesting.
Yeah. So, and with the first-time home buyers, those programs out there could be the grant assistance programs, some other 100% financing options, or some very low down payment options out there. So, but yeah, the actual answer is not on title in the past 3 years. So if you purchased a home 5 years ago, you sold it, and you have not owned a house in the last 3 years or on title, then technically you're still a first-time home buyer.
Yeah, that makes sense. I guess that kind of goes into my next question of, like, why would somebody want to get the benefits of being considered a first-time home buyer? Like, I guess what comes along with that, and kind of like, should everybody use those benefits? Or is it kind of more of a case by case?
It's always a case by case, because it depends on the qualifications of someone. Because just because you might be a first-time home buyer, you may not qualify for some of those programs, because it could be credit scores, it could be a debt-to-income ratio issue, it could be, a few things that would stop someone from taking advantage of certain programs, right? But I would say if you fall into the categories of, taking advantage of a grant assistance program, or maybe you make $200,000 a year and you don't have a lot of liquid cash, but you could put 3% down on a house, then that's first-time home buyer programs right there. So yeah, I think if you are eligible and able to qualify for something that's first-time home buyer, absolutely.
Yeah, for sure. So is that what you see most?
Yeah.
First-time home, but like if they have that benefit, most of the times they're going to use that unless they have like a different program that's really going to benefit them more.
Yeah, and that's the thing is, you know, what you have to look at as a loan officer, obviously, is, working up all of the different programs that that client may qualify for, and then you would like to go over the, the positives and the negatives of maybe each one of those programs, give advice, obviously, and at the end of the day, that client has to choose what's best for them and their family, and then that's when you go to that next step.
Yeah, for sure. I agree with that. So I wanted to, I guess, ask this. So, really, how should a first-time home buyer like mentally kind of prepare for this journey? Like, if you were to go back in time and talk to your 20, 25-year-old self, like, what were some things that you would tell him to get prepared before
Yeah,
maybe even go and talk to that loan officer, maybe?
Stability is
Mm-hmm.
probably the number one word I would say, just because, and what I mean by that is, have an idea if you're going to be staying in that property for at least 2, 3, 4, 5 years. It's not something that you need to get rid of in 6 months or maybe a year. It may not be worth it to purchase the house. Income, job stability, making sure that you have a pretty stable job. Not you know being employed 6 months, then going somewhere else. And again, that does happen. It's okay, but just like you said, going back to my 20 or 25-year-old self, just making sure that is stable, because you're going to have a requirement to make a monthly payment, and you want to make sure that income is there. But the other good thing too, I always say, the sooner you purchase a home, the sooner financially stable you would tend to be. I actually bought my first home when I was 25, and that was my biggest asset at that time. And I also made a lot of money when I sold the property, which also allowed me to put a larger down payment going into my next house that I wanted to purchase.
Yeah.
So the sooner you can buy something, in my opinion, the better, because that's a asset that's going to gain value over time. So the sooner you can actually build that equity and have that value increase in that property, that's more money you'll have eventually to do other things.
Yeah, for sure. And I think something going off of that I would say is, like, I guess we always talk about like being a house poor. I feel like a lot of people these days, going into it, they have really high expectations. They've been looking on Zillow at 400, 450,000, 350,000 price houses, when especially if you're younger and a first time home buyer, it still might be a good idea and a good like asset for you to kind of get something that you're comfortable with and more stable in the beginning, because you always have that as an asset, even if it's not at the higher price.
Yeah, we're in a different market than we were, 3, 4, 5 years ago, and my biggest thing every time I talk to a client, my first question is, what do you feel comfortable with on a monthly basis for your mortgage payment? Because there's a lot of misinformation out there, and even though Zillow is great, it's the number one home buying site out there. But, when you have a first time home buyer, or, someone who is not realizing that there's other factors that go into a mortgage note, and maybe that payment that they're looking at shows 20% down, but our client's trying to do 100% financing, or a smaller down payment, then reality check then kicks in a little bit, because that note is going to be higher than maybe what they're looking at, right? So my next question would be, okay, look, that house may not work, based on what you felt comfortable with paying monthly. So let's figure out what purchase prices we have to really look at in order to meet your goals and needs as monthly obligation, right?
Yeah.
And then that's when we kind of go into different purchase prices and different programs that's going to hopefully accomplish what they want to do.
Yeah. And I agree with that. Like, just knowing what you can buy, because you don't want to go and look at a bunch of properties that really you can't even afford, and then you get your hopes up and expectations. Like, it's like me going and look at a bunch of Lambos. I'm gonna get all excited, but at the end of the day, it's not not feasible.
Yeah, and look, even sometimes that client may be able to afford it, right? But that's not what they want to pay.
Yeah.
And at the end of the day, you want to be able to go out to dinner, go to the movies, do things with kid, whatever that looks like
Yeah.
outside of your mortgage payment. Now, is the $1,000, $1,200 mortgage payment available out there? Very difficult to find these days, right?
Yeah.
So, what I do find, again, going back to having that stable job, or maybe you have someone on the mortgage with you to help kind of offset maybe what that true mortgage payment looks like.
Yeah, that makes sense. Definitely. So I guess we can move on a little bit to just the process, because I know a lot of people don't even know like the start to finish, really don't even know kind of what happens in the middle between that. So I guess walk us through the loan process, kind of start to finish. What actually happens kind of behind the scenes with us and what's happening.
Yep. So, obviously the first step is speaking with a loan officer to put those plans and goals together and seeing what loans you qualify for. Then at that point, we're going to get with a realtor. If if that client doesn't have one already, we're going to get a realtor together so they can go look at a few houses out there in that price point. And then at that point, if they really like the house, they're going to go ahead and put an offer and, try to get a contract on that property. Okay. Once that contract's accepted, then we usually get the contract in our hands as the lending side. And then that's when the actual processing starts. So processing could mean just, gathering the few other documents that we may need that, the underwriter's going to ask for. Maybe it's some updated items. So we're going to be doing that, with the client, kind of walking them through each step. Appraisal, appraisals are typically done after the inspection. So, some people get confused that the inspection is the appraisal. So the inspections are not required by Synergy One as the lender. We don't require any type of inspection. That is really for the home buyer to make sure that house is sound, right? And there's not a whole lot of big issues. The appraisal, that's going to make sure that's a protection that's going to come in for the lender and the buyer to make sure that they're not overpaying for that property, and there's comparable sales in the area, right? Then title work is also involved, and now that's done by a third-party vendor, title company, title attorney. They're just going to make sure that there's no liens, no judgments out there on both parties, and to make sure when that client purchases that home, it's free and clear of any liens or judgments, right? So no one can come after them.
Take your house.
Right. So that's part of the process. And then, an underwriter, that underwriter is reviewing everything that we've been collecting through the early stages of the process and during, so that way they could review everything and sign off on what we sent to them. Now, they may come back and ask for other additional items that may be needed, which is very typical. But as long as we get those and satisfy those particular items, we send the file back for final approval. And then once we get the final approval clear to close, then that's when you can actually go ahead and set the closing date with all parties and things like that. So there is a lot of back end things that we do on our end that a lot of people don't know of, right? Collecting insurance, appraisals, title, verifications of employments, verification of assets. There's a lot of little things that come into play when purchasing a house. And what our team does really well with is trying to collect that as quick as possible, and that way it's a little bit easier during the process.
Yeah, because you don't want to have a bunch of stuff coming back in underwriting. Definitely, I feel the most stressful part of the process for us, at least.
That is probably some of the more stressful items, is trying to gather certain documentation that the underwriter asks for and things like that. But just know that for the most part, if a loan officer or a processor or anyone like that is asking for certain things, it's not that they're picking on that client or anything like that. It's just traditional things that is still needed in this industry, you know, to actually get a final approval on a loan. So
yeah, because we at the end of the day we have to prove all that stuff. Like we have
gotta
to prove that you even are who you say you are. You have to prove that you're gonna continue at the job and your income and stuff. So
yes,
I don't think a lot of people know that either. So yeah, you kind of answered some of my next questions. So we talked about the underwriter, kind of what that does in the process. What would you say? Because you know, when I do the Friday follow-ups, I can come across this sometimes. You know, like when they're searching for that house and they're kind of feeling maybe overwhelmed or stuck, kind of mid process, maybe even like burnt out from going look at a few different houses and maybe a contract fell through.
Yeah, look, I think unless you're in an immediate rush to purchase a home, which some people are, right, because of certain items. Could be a job change, location change. It could be my lease is ending in 30 days. I have to find a house immediately. In that case, sometimes you can't be too picky, right?
Yeah.
So you know, just want to make sure it's a good solid house, and you know, you move forward if that's what you want to do. But if you're not in a time crunch, that allows you to really pick a house that really checks off most of your boxes, right? I don't know if a house is going to check off every single box ever,
I haven't came across that yet.
But you know, unless you built it yourself, then right. But a pre-existing home may not check off every single box, and that's totally fine because you can make that house your own anyway. You know, whether it's 6 months down the line, a year down the line, you can do some of those extra things that you wanted to. But I would just say find the right property, make sure it's in your price range, have a good real estate agent that's not pushing you to purchase certain houses. You know, your real estate agent has your best interest, just like the loan officer. You know, we're trying to accomplish all one goal is to help the client purchase a house, right?
Yeah.
So, you know, sometimes just need to take your time a little bit, understand the process, understand, you know, the payment, you know, and again, it's an asset, but it's probably the largest asset that someone's going to purchase is your house. But, you know, it's an asset too if you need it to sell or, you know, life brings certain changes. You know, it's an asset that's pretty easy to sell if you need to, right?
It's almost like a savings, like an
correct
savings.
Yep.
So I agree with that. What about an escrow account? I know that we'll talk to people about that, but they don't even really know what that means, what that is. How does that work?
Yeah. So, you know, when I discuss an escrow account with my clients when they're purchasing a house, and that's some of the things that, to be honest with you, a lot of first-time home buyers don't know about. And so I think that's a good question because that is part of your monthly payment in most cases, you know.
I feel like it affects it the most almost. Like
it does, you know, because, you know, we're in Louisiana. We have some of the highest, if not the highest, homeowners insurance rates out here. You have property taxes. You know, you have a combination of a few things that actually total up that payment. So that's another thing too. When you're searching on, you know, some of the home sites, you might see a house, you know, that has a pretty low payment, but they may not be calculating the right insurance or taxes on that property. So it's always good to kind of overestimate on some of those things. You know, when it comes to taxes and insurance, then underestimate.
Yeah.
And that way, you know, the client's not shocked when they get the official quotes back from an insurance agent or something. You know, now, again, we have no control over as a mortgage company, a loan officer, on what an insurance policy will be. For homeowners insurance, you know, we have zero control over that because it's all based upon typically the house and the client, which is done by, you know, the insurance is done by a third party. So, but the escrow account is going to include homeowners insurance, flood insurance if it's in a required flood zone, property taxes, and if you're doing a loan that requires mortgage insurance. That's basically going to be your escrow account that's built into your principal and interest payment, which is your mortgage payment itself. All of that's tied into one.
Yeah.
Now, let's say if you were purchasing a condo or a townhouse, there's something that's called HOA dues, homeowners association dues. So sometimes that could be $100 a month. Sometimes it could be $500 a month. Depends on that complex condo or townhouse that you might be purchasing. Now, that is not included into your actual mortgage payment. That is totally separate. But what some people don't realize is if they're buying a property that has HOA dues, it's actually part of the overall debt to income ratio.
Oh, we do have to include it? Okay.
Do have to include it. So that's why I tell my clients if you're maxed out at $300,000 on your purchase price because of a debt to income, we have to be very careful on what an HOA due may cost.
Yeah.
Right.
Yeah.
Because that could put us over the approved level, even though it's not officially part of the monthly payment. It's a part of your monthly debt. Right. So that's another key factor that you just have to be aware of is HOA dues.
And I would say it's like 50-50 on people that absolutely hate HOAs, and then about 50% that don't really mind.
Yeah, I mean, I guess if they're taking care of your property and using that money the right way, it makes sense. Or someone who may not want to cut their own grass or have that maintenance. In a condo or townhouse would be perfect for someone, right? But I can get
and there probably is some horror stories out there with HOAs.
100%.
Yeah, for sure. So I like what you just mentioned, DTI. So I was kind of going into like the next topic is like qualifying and what those details are. So like when you say DTI, can you explain that a little bit, and like how does that have an effect on you purchasing a home? Like how is that even calculated?
Yep. So DTI, debt to income ratio. So that's a factor in every single loan that you do in mortgage lending. Now, there's factors that go up to a higher percentage on some loan programs than others. But a debt to income is considering, and let's just take a W-2 employee. If you take your gross income, okay, then you have all your other debts that may be on credit, vehicle, a credit card, etc. Then you add in your mortgage payment, okay? So adding in your mortgage payment plus all your other debts, then that's where we're looking and calculating your debt to income, okay? So it's, as for our W-2, it's taking that gross income divided by mortgage payment and all other debts. And then at that point, you have to be at a certain level, right? So if you're at over 60% debt to income ratio, then that's a red flag for a lender to lend money because we don't think that's affordable for someone, right? So there's different ways to look at it, but for the most part, typically, even though this sounds pretty high, but there's like a program like the FHA, they'll give approvals up to 60%. Wow. We don't see that very often, but we have a lot though at 55% or below. But maybe the client also has a side job that we're not using because of qualification purposes, or maybe they have a roommate that's going to be in there and helping them. And even though that debt to income ratio is at 50%, they technically have other money that's coming in. So, on their end, it's fine, right? Self-employed, which we do a lot of as well, they don't take the gross income, right? Yeah. So, if you're self-employed and you have a gross income of $200,000, but you write off $100,000, then that leaves us with $100,000 in net income that we could use to qualify. So that's taken a little bit different. And then there's a program for, investors that are based on just what the rental rates are pulling in for investment properties. So technically you don't even need income documents on those. So that's a different subject, but you can kind of see there's different programs that require just different requirements and guidelines that we try to look out for the client with and see what's the best option.
For sure. I guess it was something that popped in my head when you were talking about the self-employed. Do you have to have an actual signed lease if you want to use that rental income to kind of offset?
So some programs, yes, some no.
Okay.
Yeah. So it just depends. Like, an investor program, which is called the DSCR program, you don't have to have a signed lease to purchase the property. You just have to have the appraisal that actually shows the going rent rates for that area. And as long as those rent rates, equal or greater than what your principal and interest, taxes, and insurance are on that mortgage payment, then technically that's the proof right there for this investor program.
Yeah.
So it just depends on the program, but some do require a signed lease. Absolutely.
That makes sense. So I guess going to the next topic, so we talked about DTI, and I kind of feel like these four are really, I guess, the main things that kind of decide your what you can qualify for and buy. So we just talked about DTI. The next would be credit score. Like, how does that really affect your ability to buy and kind of qualify for a certain program? And then I know there's kind of like a tier list. Like, what are the benefits of having a higher credit score rather than a lower one?
Yeah. So here at Synergy, we actually start at a 500 credit score, which is pretty amazing, right?
Yeah.
So look, maybe the reason that person had a lower score, just, something could have happened out of that person's control. You never know, right?
Mm-hmm.
So, but we start at a 500 credit score. And of course, there are more requirements with a lower credit score client compared to someone who might have a 750.
Mm-hmm.
Okay. Do you get better interest rates with better credit and things like that? That's definitely true, right? It's just that's how the market is. If you have a better credit score, you're going to get a little bit better interest rate, in comparison, which ultimately lowers that payment a little bit. But at the end of the day, again, going back to affordability, is this the right time for someone to purchase? If someone came to me right now and said, hey, I have a 550 credit score, but I have 10, 20% to put down, should I wait to purchase something until I get my credit scores up to 700? Well, not my place to kind of say you should or shouldn't, but your score may not get to 750 for another year, a year and a half. It just depends on that situation. So are you willing to lose out right now on a property and maybe even pay more for the purchase price in a year to year and a half? Or do you take, based on your credit score requirements now, look at the numbers, and if it makes sense, purchase, right?
Yeah.
So I always say if the numbers make sense, if you can be helped with your credit score, then you make the decision if it's the right time or not.
Yeah, I think that's a great point. I didn't even think about that.
So, but, different programs do require different credit scores. That's for a fact, right? Yeah. So, the lower the credit score, there's going to be fewer buckets that, you're going to probably qualify for. Yeah. But, look, I'm excited if I can help someone with that lower credit score tier because, I can help someone purchase a house a lot sooner than them waiting, to have that little bit better credit score. And look, at the end of the day, maybe it would save them $100, $200 a month on their payment in some cases, depending on purchase prices and down payments. But that may not be that big of a factor for someone. Having their own house for their family could be the biggest satisfying item, right?
Definitely. Yeah, I think just our conversation, and I feel like just every conversation I have with someone, it always just goes back to just getting in touch with a lender and loan officer because there's just really so many different routes and opportunities. And I just feel like every question just comes back to that. You gotta talk to a loan officer and get the true numbers.
Yeah, and look, it's a big step, right? Yeah. A lot of people are nervous to go and talk to a loan officer and things like that. But at the end of the day, you shouldn't be nervous, because if I tell someone, no, we cannot help them, I'm going to tell them the reasons and hopefully get a game plan for that person to be able to purchase in the future, right? But there's so many clients that we help that didn't realize that they could buy a house right now.
Yeah.
And when you tell them, hey, I could help you purchase this house, I mean, that's super exciting.
Yeah.
You know, and that's some of the enjoyment that we get as loan officers that, you know, this client was coming in not sure, very scared, things like that. And when, you know, we really get to know that client, have them open up to us, find out their goals, and, you know, those items, it really helps us, you know, feel better and, you know, get them to purchase a home. So,
and I feel like it'd be really discouraging, you know, looking online and, you know, seeing something that says like, oh, you can't qualify because of this that you might relate to, but it really might not even be true to your certain situation. So I think that can discourage a lot of people.
And look, maybe the time's not within the next month, 2 months, 3 months to purchase a home, but maybe that person has a question, you know, or like, hey, I'm kind of dealing with this, you know, what are your thoughts? You know, we're always open to having those conversations, whether we can help a client today or in the next year, you know. So it's just about the communication, which is really big in our industry. It's just making sure we're understanding every aspect of our clients.
Yeah, it's good to have that connection in your back pocket, I think, if you're a buyer. So we talked about DTI credit score. I think the next big thing is job history, right? And kind of how you get paid. So how would job history and then also how you get paid kind of affect your ability to qualify? Like,
So there's a lot of moving parts with that. You know, for the most part, someone has to have a 2-year history of work, right? But what you don't realize is, let's say someone just coming out of college and they had 4-year degree, 2-year degree, whatever that looks like, and now they have a job. We can use the history of the schooling to help offset an official job history, right? Which is cool.
I thought that was so cool when I learned that.
Yeah, so it's not that you have to be employed with someone for 2 years, but, you know, now that's, you know, obviously based on schooling, but if someone, let's say, was working, something happened, and now they haven't worked in 2 years, and now they're just getting back on the job market, that's a big issue. Right? So you'd probably have to be on that job for at least 12 months before someone would consider, you know, you being eligible, right? As far as self-employed, you know, we actually have some programs that will allow self-employed income, you know, for only 1 year, right? And honestly, we have some other outlets too. If, you know, let's say it's you know, they have a decent job history, maybe it's a new field or something like that. There's different, you know, different programs that we do have that still may fit into some buckets, but just general, you know, it's, you want to have a 2-year history of something like that, right? Now, when it comes to, like, let's say commission, you know, a commission job, that's a whole other thing, right? And is it W-2? Is it 1099? So there's a lot of things that we have to look at, but let's say a commission job, for the most part, you know, they might be looking at a 2-year history of your commissions to make sure you're averaging enough to make these mortgage payments, right? So, you know, sometimes just on a commission job for 1 year, maybe there are some programs that we can look at, but for traditional style financing, they're going to want 2 years.
Yeah, for sure. And I guess something to kind of warn people, like, you don't want to, say if you switch jobs, you don't want a big gap in between that, right? Like, that kind of throws a wrench.
Yeah, I mean, for a lot of the programs out there, they want you to, if you are going to switch jobs, try to do it in a timely manner. You know, whether it's a week, 2 weeks, you know, when you start getting into 30 days gaps of employments, that starts to deteriorate certain programs that you can do because they don't want to see gaps, right? Another big thing too, I help a lot of veterans out, and, you know, let's say if they're in the military, they're active duty, let's even say they just got out, right? And they're in civilian status as far as, you know, getting into the job market. A lot of times the VA wants them to have at least 12 months, if not more, on that job unless they did something very, very similar in the military. So let's say if you were a mechanic in the military or something like that, and you got a job, as an auto mechanic or something like that, as soon as you got out of the military, then that's a history, right? But if you were a mechanic in the military, then became a loan officer, then they're not going to allow you to use that income, right? Until you have at least 12 months. So, the job history, it's just always good to have that conversation if there are job gaps or if there's, going from one job to another. It's good to have that conversation with the clients just to make sure we're not missing anything. Because at the end of the day, as a loan officer, we're just trying to really look at the upfront items to make sure that there's not going to be an issue in underwriting. Because at the end of the day, those underwriters don't miss anything.
Oh, yeah.
So they're gonna find out. So.
Yeah, definitely. They're gonna let you know.
Yeah, will.
So I guess that those three things are really how somebody can really kind of boost their approval odds, right? Is there anything else you can think of that can really help somebody?
I would say the number one thing is just credit. Paying bills on time. Try to avoid collection accounts, things like that. Having a decent credit score out there will get you a long way. And that's buying anything. That's buying a car, a house, applying for a credit card, whatever that looks like. Your credit score is the biggest factor with everything, right? So I would say credit scores, making sure that you can handle a monthly payment, and see what that looks like. Do a budget, if you're renting a property right now for $1,500, but your budget allows you to really go to around $1,800 to purchase a house, then know those numbers, and then that way we can figure out what purchase prices are going to give you a specific payment that you feel comfortable with.
That makes sense. And this might be a tough question to answer, but say for somebody that's planning to buy at the end of this year, what do you think they should kind of plan to save? If you hadn't, I know it's probably a tough one to answer.
Well, look, I would say save what you can. Because there are programs out there with grant assistance and 100% financing if that person qualifies, right? But I would say if your goal is to purchase a house next year, let's just say that, then do everything that you can to save as much as you can. Because not only. But let's just say even if you qualify for something that doesn't require a large down payment, well, you may need furniture. You may need other things when you're buying a house. You might need to upgrade appliances, right? So instead of, trying to go finance some of those things outside of it after closing, you may have some liquid cash just to go pay for it, right? So I would say, just save as much as you can. But at the end of the day, still, you may want to still even get an outline. Even if someone said, hey, I want to purchase next year, I would still say, well, let's look at it right now. Get a game plan together. And then I could tell you, maybe you do need to save $5,000, $10,000, right? Maybe you don't need to save anything. Maybe at where you are right now, I could help, right? But just for safe measures, if you do want to save a few dollars, to have a safety net, then I would go ahead and save what you think you might need.
Yeah, I agree, and it all goes back to just talking to a loan officer and lender, because you don't want to waste a year of your life thinking that you're working towards this goal, and then you get there. That's really discouraging.
Very discouraging, and some people think they cannot buy until the future later down the line when they can actually buy now. So, and again, like you were saying earlier, it doesn't cost a buyer to apply, to look at numbers. Does not cost anything. $0 for us to look at that, and then we can give them a game plan together, and then if it is 12 months down the line, well, let's keep in touch. Then, when that time comes, we'll be here to help.
Yeah, for sure. I agree with that. So I guess just kind of on like the lifestyle and big picture, I want to talk about some things that everybody knows that you can build equity. That's obviously got kind of like the normal, but some other benefits of home ownership beyond just equity.
Yeah, so again, that is your biggest asset
Yeah.
more than likely. Like you said, it's going to build equity as every time you make a payment, or the values are going to increase, throughout time, right? Which is one of the biggest advantages, right? So, but some of the other things is you get tax breaks. If you are looking to possibly open up a business, um, let's say you're looking to open up your own business, they might ask for collateral.
Yeah.
Well, if you didn't
Have
own a
something.
house, then you may not be able to get a business loan because they need collateral. That's one huge thing. Other thing is, let's say if you wanted to start becoming an investor. Well, a lot of those investor programs, might have to own a house already.
Yeah.
Right. So those are some of the biggest things. Again, could be something way down the line to where you purchase a house, you keep it as a rental, and it's something that you can hand down to kids, grandkids, or whatever that looks like. That's called, if you want to say like a general, wealth situation, then, those are just things that would help owning a property. And again, going back to when I purchased my first property, I want to say I made almost 75,000 off of it.
Nice.
I think I sold it after 7-8 years of owning it.
Yeah.
And I made that kind of money off of that one property.
Yeah.
Right.
So now get your money back and more. That's
absolutely.
Awesome.
So, those are the things that's the perks of owning a property. Now, owning a house come with maintenance. There's no doubt about that.
Yeah.
But if you're able to cover the maintenance, the mortgage payment, it's still, in my opinion, better than having to, pay someone else's rent. Or I guess I would say someone else's mortgage.
Yeah. Then you just have like the pride of ownership, like you own.
Yeah,
that
absolutely.
House, like
it's your
yours,
house. You can do what you want with it.
Yeah, exactly. When they're thinking about like what you were saying, how you made 75 off just the equity, because obviously you'd probably appreciate it. Is there anything you think like advice to give somebody on like the resale value, or like future proofing their decision, or like something that they should maybe look out for if they want to?
Yeah, I mean, look, at the end of the day, you're going to purchase a property in an area to where you feel comfortable purchasing, right? It could be a up and coming area to where, maybe in 5 years, you might have almost doubled your investment or something.
Yeah.
You just never know. But when someone's purchasing a property, I think location is huge. Whether it's going in for just investment purposes, or it could just be, hey, this is close to my kids' school, and this is where I want to be because it's easy. So as long as you're not, getting advice from someone who's just trying to put you in a house regardless, and, they don't give you the pros and cons of maybe purchasing in a specific area, but that's also where a good real estate agent is going to come into play to help make that decision and show you, like, okay, here's, some areas that would be a good investment. They can kind of help with that a little bit as well.
That's exactly what I was going to bring up. I feel like a real estate agent, like at least a good one, can really give the buyer knowledge.
Oh, absolutely.
Yeah. Well, man, is there anything else before I guess we get to like maybe 3 little fun questions? Just to end it off, was there anything else that you think a first-time home buyer could benefit from, or just off the top?
Look, I always say again, if the time is right, purchase. If you feel like the time is not right, take your time. You'll know when it's right to purchase. But again, get the numbers, do a budget, find out the goals, and then make your decision based on that. Right. Yeah. It's always, in my opinion, to purchase sooner than later if you're trying to get into owning a house.
Yeah, that makes sense. I like that a lot.
Yep.
I guess one last thing. So if let's say like mortgage was like dating, what kind of red flags do you think buyers should look out for like when they're trying to find that loan officer?
Yeah, I mean, look, there's probably 80 to 90,000 loan officers out there, right,
Mm-hmm.
in the United States, which is actually a huge decrease since
Yeah,
since
good for
COVID.
us.
But it's just finding that right person that communicates with you well, knows the programs, has the programs, because believe it or not, there's a lot of banks and lenders that do not have the same programs. Um, you know, Shout out to Synergy
Mm-hmm.
One Lending, we have a ton of programs,
Yeah,
and a lot more than most. So that allows us to help more clients and put
yeah,
them into payments you know, and really meeting their goals to be able to help them purchase. So I would just say, knowledge,
yeah,
working with the people with the right knowledge and programs out there is
yeah.
that's the biggest key.
It needs to be somebody you trust, and we can talk about this on the next episode. Just it needs to be somebody you trust, especially, and we can kind of go over, I think on the next one, what to actually what you're actually looking at when you see like a loan estimate document or a closing disclosure. I think we'll go into that one on the next episode. But last question I have for you. I mean, you have like a crazy story of just something in the process, or maybe like the worst.
Look, I've been doing this since kind of in the industry since 2005. So it's pretty long time, right?
Yeah,
I mean,
seen some things.
yes, but I've had people quit their job and not say
Oh
anything,
man.
and then we find out, then they can't buy the house.
Ooh.
We've had people get married, not tell us, which
Uh,
Louisiana is a community property state, so those types of things we kind of need to know.
yeah.
So there's a couple of things that's been done out there for sure,
Yeah.
but at the end of the day, we're all trying to help someone purchase a
Yeah.
property. So I say, if someone is looking to make a move and whatever that looks
Yeah.
like, just talk to us,
Be
communicate.
transparent.
That's
Yeah.
it.
To
Yep.
tell us that because underwriter's gonna find out one
They're
way or
gonna find
another.
out.
So
Yes,
so
yes.
better to get it in the beginning than
That's
the
right.
end. Well, I appreciate you doing this again. I think this was really good. I think a lot of people will gain knowledge, really just from this. So obviously, where can they kind of contact you at? I know that I'll put your website in the description. They can go apply now or give you a call just to
Yeah.
talk to you.
Yeah. I mean, look, easiest communication is look, shoot me a text, call my cell, email me. That's it.
Yeah.
Just, that's the easiest ways. And that way we could have direct communication, easier responses that way. I'll always try to get back to my clients very quickly. That's very important for me and my team,
Mhm.
is communication and timely responses. So I would just say, yeah, cell numbers everywhere you could find it,
Yeah.
email
Yeah.
address,
Yep.
text, whatever.
Yep. And so I'll have Aaron's all of his socials, his Instagram, Facebook, website. So if you guys want to go contact him or just kind of learn more about your situation, or just get a game plan again to put together, I would definitely give Aaron a call and we'll kind of go from there. And then if you guys learned anything from this episode or just enjoyed it, I would appreciate if you like, share, subscribe, and then we'll see y'all in the next episode.